Hi, I'm John Hageman. Welcome to KNN. Today I'm here with Bob Knakal, and today we're going to talk about the 2023 investment sales outlook for New York City. So Bob, in our last episode, we covered the year-end 2022 statistics, what we saw throughout the market. Today we want to talk about what we expect to see in 2023. Why don't you tell us what you're thinking?
Well, Ags, I think 2023 in a lot of ways is going to be similar to 2022. Meaning that each product type is going to perform very, very differently. In New York City, we have four major food groups. Those are land and development properties, multifamily, office, and retail. Clearly, we have a very robust industrial market, but based on zoning, it's a very, very small slice of the pie here in New York. Hotel market is also another product type that we look at tangentially, but not a main part of what our business is. But I think that what we saw in 2022 was that land reset when lenders started to increase their lending rates based upon interest rate increases. We saw a big shift in the market. Land values dropped by 20 to 25% in Manhattan, seemingly overnight. And that reset in value was met by demand. There's demand, there are transactions happening. Again, we're getting into a market like in 2020 where we were doing land deals below $400 a foot. That was not the case in 2021 or the first half of 2022, but we're back there again. But there's a good level of demand at that level. Multifamily transactions, I think a lot of it depends on whether the building is a post-business plan building, has all the low-hanging fruit been taken out of that building or not. And the buildings that have a lot of value-add capability are still in high demand. And the buildings that have been worked, they're much more sensitive to what lending rates are. And if we look at the office and retail sector, office still trying to find its footing. A number of secondary and tertiary buildings asking $400 a foot, unable to get them. We've seen rents in those buildings drop pretty significantly, but yet Class A office seems like it's doing great. You're getting triple-digit rents wherever that building happens to be. So we've seen trading in the office sector, but a much lower level of volume than we've seen in the past. And retail assets seem to be finding some footing. It seems like the retail leasing activity has picked up. It's at a lower price point. It's been readjusted in terms of retail rents, but we're starting to see investor appetite for retail once again, which is a nice positive shift. But I think how 2023 is going to play out is really going to be very product specific. And within each product type, the different Class A, Class B, Class C, I think they're all going to perform a little differently.
That being said, what do you think one of the major things is that's going to drive activity in 2023?
Number one thing that's going to drive activity, Hags, and not many people are talking about it, is refinancing risk. Virtually every refinance is going to be a cash-in refi. So when that owner is faced with that decision about what to do they put fresh capital into the building to hold on to it? Or there's probably an equity cushion. They could sell, pay the lender off, maybe take a few dollars out. But that's going to be the biggest decision, and we're seeing many clients facing that decision already. But mortgage maturity is going to create a lot of trading activity. We have clients who are looking at their portfolios, figuring out which properties they absolutely want to hold on to, which ones they might sell to raise the capital, to put it into the buildings that need that fresh capital to effectuate the refis. But based on where lending rates are today, banks are not going to be able to extend and pretend the way they did in 2009 and 2010. And that refinancing risk is going to be a driver of a lot of activity that we're going to see in the market next year.
Bob, one of the things we talk a lot about is the secondary office market, right? And how it's had its struggles as it competes with the newer vintage Class A, new construction space. What are we seeing specifically in that? Because I know that's something that a lot of people are talking about.
Right, and Ags, I think it's really interesting in the office sector how Class A new construction is almost a completely separate asset class than the rest of the office market. Office stock in New York is very, very old. generally. A lot of buildings have been owned for a long time. If you look just at turnover ratios, the average building is owned by the owner for 40 years, which means half the buildings are owned for longer than that. So, there are a lot of owners of secondary and tertiary office buildings that have owned those buildings for 70, 80 years. The buildings are a little tired. There is tenant demand out there, but you have to have an upgraded lobby, hallways, elevator mechanicals, new bathrooms. Buildings need to be competitive from a physical plant perspective to capture the tenants that are out in the market. And some buildings don't have ownership structures where they want to put fresh capital into the building. Those buildings are really having a tough time attracting tenants. And so those owners are going to have to figure out if they're going to be able to raise the money to increase the quality of the building, or will they sell an interest in the property, do a long-term master lease on the property, do something to make that building competitive to be able to attract tenants. One of the things that could help the office sector also is if the city enacted a 421G type of program to incentivize the conversion of a lot of this older office stock into affordable housing, which would be great for the affordable housing market, also would be great for the office sector. But the office market is going to be very interesting to see how things pan out as tenants have leases expiring, need to renew. We're a couple of years into this work from home experiment and need to figure out how that's going to impact aggregate office demand. And it'll be interesting to see how that aggregate demand translates into fluctuations in property value moving forward.
One of the things you mentioned was the positive signs that we're starting to see in the retail sector. You want to give a little bit more color on that?
Yeah, I'm actually very bullish on retail these days. We've seen retail having a tough time for a long time, but retail leasing activity is starting to pick up, albeit at a lower rent level. But based on the new rent level, stores are getting leased. There's more street activity. If you walk around the streets of Manhattan today, you see a lot more pedestrian traffic. That's good for retailers. As people get back into the office, that's going to be a better indication of how retail is going to do. But generally, we're starting to see the investor appetite coming back for retail and people asking about retail, which hasn't been the case for a couple of years. So that's a very positive sign. I expect retail to do pretty well next year.